Welcome to the DWS Market Outlook. What are our economic and market forecasts given the disruptiveness of US policy making? Over the next 12 months, markets will be heavily influenced by US politics, just as they have been since Donald Trump took office in January. Quick and radical shifts in US policy have sent the markets on a roller coaster ride ever since. Looking ahead, we must ask ourselves, have we passed peak uncertainty? Or will US policy still be surprising us at the end of the year? You can make good arguments for both. But one thing is fairly certain already. Global trade is changing, not least because we expect the average tariff burden on US imports to quadruple. This should initially dampen economic growth, especially in the US, but the long-term impact on supply chains and individual sectors is difficult to predict. We believe, however, that we have passed peak tariff uncertainty. But this will not prevent further trade-related headlines to stir up markets in the coming months. These are the risks, but our base case scenario assumes that there will be solid economic growth in most regions. For the US, we expect economic activity to slow down over the coming quarters before re-accelerating in the second half of 2026. In Europe, increasing fiscal spending should help to lift the growth outlook. All of this should allow for further earnings growth in equity markets, and it should also keep corporate bonds defaults low. Overall, our return expectations for the next 12 months for most asset classes are positive, but the regional aspect plays an important role this time, as we expect the dollar to weaken. Given the big geopolitical uncertainties, we're focusing on diversification, including using gold as a hedge. Will bondholders lose patience with government debt this year? Bond investors face a challenging year ahead. They need to decide by how much the US tariff policy will reduce growth and increase inflation. This question is made all the more difficult by the many economic policy changes. We continue to believe that the market will ensure discipline of US policy and that the Fed will continue to act independently. We expect the Fed to be cautious about inflation and not make the next interest rate cut until the fall. Overall, we expect 4 US interest rate cuts by the summer of 2026. This should cause yields on 2-year treasuries to fall. However, the focus is currently on 10- and 30-year government bonds. They are being put under pressure by the high US budget deficit, and foreign investors in particular may no longer feel welcome in the US, especially as a proposed bill would make it possible to charge them taxes for holding government bonds. The US government is playing with fire here, but we believe that the Fed will move swiftly to put the fire out. It has various tools at its disposal to do so. This is why we see interest yields in 12 months' time basically at today's level. In Europe, by contrast, German government bonds have cemented their reputation as a safe haven. Even the expected increasing supply of bonds is unlikely to cause yields to rise significantly. Our base case scenario therefore predicts a good year for government bonds. This view is even more pronounced for corporate bonds. We believe they offer attractive initial yields and therefore a bit of a buffer against price fluctuations. Given the high risk to our core scenario, we currently favor investment-grade bonds. Are equity markets too optimistic in these uncertain times? We expect solid equity returns in the mid-single digits over the next 12 months. This may seem a bold prediction given the uncertainties in global trade, but our core scenario provides good reasons to hold this view. We believe that many of the questions relating to US tariffs and taxes will be resolved by mid-2026. We expect global earnings growth for listed companies to be in the high single digits, and we expect that the level of earnings growth to continue in the US until 2028. As a result, we feel comfortable with the current high valuation multiples. In the US, the S&P 500 continues to be driven by tech companies. These have again delivered strong figures in the current difficult years, not least because the software and internet firms are little affected by the tariff dispute. However, this could change if America's trading partners consider raising tariffs on services. In Europe, the economic cycle is stabilizing. supported by government spending programs. Here too, a handful of heavyweight stocks have driven markets. However, we are focusing more on small caps, whose valuations have become relatively more attractive. We believe this segment is capable of growing its corporate earnings faster than the economy. We keep Europe on overweight in a globally diversified portfolio. Despite a bumpy start to the year, we're sticking with healthcare as our favorite sector. Innovations in this sector, just as in the technology sector, should continue to provide the foundation for sales growth.